Hi, Scott McLeod from Brown Financial Advisory. I just wanted to spend a few minutes with you to help you understand maybe some context around a question that's come up a couple of times this week. A client asked me, and actually more than one, asked me, how does the most recent volatility affect my retirement plan? So one of the clients was actually in retirement, one was approaching retirement, and then another is a few years away from retirement. So I thought it'd be important to spend just a few minutes and really outline and help you understand how volatility like this impacts the financial plan and how we compensate for this type of volatility. So let's take just a few minutes and get started. Here's our agenda. So I want to talk with you first about understanding valuations and future performance, because there's a relationship between the current valuation of a stock or an asset class and what the next period of performance might look like. So we're going to talk just a few minutes about that. The next thing I want to share with you is our projections for future performance. So we have actually an intermediate term projection that we have revised, and we revise periodically and include in our financial plans. So as valuations change, we want to reflect that in the financial plan for the 5-year outlook, and they have significantly changed. So we feel like it's time to begin making that change in our portfolio analysis and in our financial plans. And then the last one is fundamentally, are my plans for retirement at risk now? So in other words, if I'm pre-retirement heading that way, are my plans for retirement at risk? Should I reconsider the time frame? I'm in retirement. How does that change the outlook for my retirement? What should I be doing differently, if anything, to compensate for that? And is my retirement at risk? So I think by the end of the presentation, you'll have a firm understanding of how those things are related and how it impacts your financial plan. The first thing is I can understand where the question would come from. As you can see from year to date, this is through the end of September, the asset class performance has been terrible this year. In fact, U.S. large company stocks are down about 24% on the year. Even bonds are down almost 15% for the year. And you can track this back even with the volatility that we saw in 2018, 2015, 2011. We really have not seen this type of market volatility since 2008. So even though you'll see later this type of volatility, 20% declines typically come around every 6.3 years or so, we have not seen this kind of volatility since the Great Recession. And so if you've not been around or not been investing for really quite a long time, you may have never experienced this type of volatility before. We've been doing this for a long time. So I've been doing this for over 25 years. And so as a result, I've seen this type of volatility numerous times. But we've had a nice long stretch of growth, and the markets have been relatively stable during this time frame. So it feels a little unusual. It is a little bit unusual, especially over the last 10 or 15 years. And so, so it's not unusual in the grand scheme, but it is a little acute as compared to what we've experienced recently. So, so the question then comes up about that, and how does it impact the markets? How does it impact the future outlook for performance? And this is a chart of valuation that I've shown you a couple of times in the last couple of webinars, but the valuations have actually continued to improve. So now the forward price to earnings ratio is just a little bit above 15. The long-term average, the last 25 years, that average ratio has been 16.8 times earnings, and that is a dramatic improvement. The higher the valuation, the lower the outlook for performance. So that now that we're undervalued as it's measured by forward price to earnings ratio, that actually gives us a pretty good outlook for near-term and intermediate-term performance. One other thing I'll point out about this chart is, for the first time in many years now, the CAPE ratio, which is the Shiller PE ratio, is actually below its 25-year average. This is extremely important because the CAPE ratio is one of the better predictors of future performance when it comes to measuring the market performance going out forward. The relationship of valuation as it relates to the CAPE ratio and future performance is very high, and therefore a CAPE ratio that's below average implies that now we have some really good upside in terms of performance in the market. So this is a great measurement, and actually relatively good news for what's happening in terms of the market volatility. I'll put this in context just a little bit. These charts, a little bit busy, but they basically explain that relationship between valuations and performance. And if you look on the left-hand chart, it does tell you that the the chart looks like a scatter plot, and that's basically because the correlation between 1-year returns and current valuation, that correlation is not very strong. So that relationship is not very strong there, but it still is a positive relationship in the sense that the lower the valuations, the higher the return. And so if we punch this out about 5 years, that relationship becomes a lot more predictable. In fact, this number down here says that relationship explains about 36% of the performance, which is a meaningful portion of the performance. But I'll show you how this works. So back before the correction, back before the market declined, we were trading at a little bit better than 20 times earnings. So if you track this to 20 times earnings and then map it to this average performance number, you can see here that this is very, very low single-digit performance over the next 5 years for the S&P 500. In fact, Vanguard, right before the market started to decline, basically said their 5-year outlook was 0. So there was no potential for the U.S. market in the 5 years prior to the decline. Well, now the market prices have come down and valuations have improved dramatically. So that means earnings have not fallen as much as the prices, and therefore the pricing is much better and the outlook for the performance is also much better. So we're now trading at 15.1 times earnings. That puts us now closer to maybe a 10% average return over the next 5 years. And that gives us a much better outlook in terms of performance on the portfolio. Based on the previous slides that I've shared with you, like this one, for example, whenever the market has declined 15% or more over the last history of the market dating back to the Great Depression, the average 12-month return following that 15% decline has been 55%. So it's not uncommon to consider, if you put those two things together, well, if the market declines, the outlook for future performance should improve, right? So that's what this chart basically explains, is that the average 12-month return after a significant decline like 15%, that average 12-month return has been 55%. Well, we are well beyond 15% now, and so therefore the return, the bounce on that portfolio upside is really quite optimistic and really quite positive. So you would expect those two things to correlate: lower valuations, returns higher in the future period that follows. So what that does then, it impacts our asset class performance projections. And what we've done here is we've revised recently our financial plan performance projections for the next 5 to 10 years. So at the current valuation levels, the Brown Financial 3763 outlook is a performance of about 6.1%, still modest as compared to historical averages, but much higher than it has been. So to put it in perspective, our financial plans for this particular model over the last 3 or 4 years, we've only included about a 5% return on this model because the valuations were so high. The outlook just wasn't great. And so we've now revised our 3763 model to include a higher performance number, which is absolutely reasonable after declines like this. And instead of 5%, now the outlook is more like 6.1%. And this has improved dramatically, and it actually will continue to improve as interest rates go up, because bond yields will continue to go up. So this number will actually continue to go up. It's actually a relatively conservative figure based on what we see right now, but we want to keep it conservative, but we think the outlook on the market is about 6.1%. So now to answer the question, what are my retirement plans? How do my retirement plans change based on the outlook from the current volatility? And this was the question that came up. So Scott, we ran our financial plan a couple of years ago. We did the revision this year, and now the market is down over 20% for the year. How do my retirement plans change? So the way that I responded to that is, you may be surprised by this answer, but we included this type of volatility in your plan. And the person continued to say, well, what do you mean exactly you included the volatility? We had a growth rate in the plan, and now the portfolio has declined. Well, the way we include the volatility in the plan is we know that it's going to come. I mean, this chart just reinforces that. You can see 5% declines on average. If you go back to 1948, 5% declines on average happen about every 3 times a year. I mean, you're going to see declines of 5% or more. 10% declines happen almost every year, which is I get a little surprised when people act surprised by a 10% decline, only because it's so common that it seems like it should be a regular occurrence. It's the normal part of doing business with the stock market. A 10% decline. 15% declines on average happen about every 3.5 years, and we've had 20% declines occurring on average about once every 6.3 years. So it's regular enough that if a 20% decline comes around every 6.3 years and you have a 30 or 40 year retirement time horizon, then it would be foolish not to include that in your plan. And so what we do is we incorporate that volatility in our plan analysis. We do it in a couple of ways, and I'll demonstrate what that means in a second. But we include this type of volatility in every plan because it is a normal part of doing business with the stock market. So if you want higher returns, if you want those outsized returns in your portfolio, the only way you can get those outsized returns is to take a little bit of volatility. And if this comes around every 6 years, then of course we would include that in the analysis. So volatility is not uncommon or permanent when it comes to the stock market. Therefore, it is always included in every financial plan that we do. So as we've run your retirement plan projections, it's in your plan too. So the thing that I want to share with you is an illustration of a basic plan here. I have Mr. and Mrs. Scott Test that we're going to run out. Scott and his wife are 67 years old. Their life expectancy is 95. They both retired 2 years ago, and they have $1 million IRA in that same 3763 portfolio, and they're pulling about $33,000 to add to their Social Security benefits to meet their retirement needs. Now, this is an important illustration because this part of the assumptions, we're using the old growth rates. So this is pre-correction, if you will. Maybe it's the beginning of this year that we run the analysis for Mr. and Mrs. Scott Test, and I'll show you that illustration. Then we do a revised case analysis where we run the same thing for Scott and his wife, same assumptions, but now it's today. So we rerun the analysis and the portfolio is down 20% or more. So we say 20% decline. Now the portfolio is worth maybe $800,000, same portfolio allocation. But because the valuations have improved and because we expect the portfolio to bounce in the next couple of years like it always has in the past, then the average return increases slightly on this portfolio. So we've included that in the analysis, but the need is the same. So we have the same portfolio distribution before and after. So what I'll do, I'm going to actually show you some live planning, just like we do in your normal analysis here when we do a financial plan analysis for you. And I'm going to show you what that exactly looks like. So this is the test portfolio. And the first thing that I'll show you here is the lifetime portfolio value based on before 2022. So let's just make the assumption that we ran the analysis in January of 2021, okay, or excuse me, 2022, right at the end of 2021, right before the market started to decline. So the test would see this result based on those assumptions. We would expect their portfolio to grow modestly over the next few years. Right around age 80, the portfolio starts to decline. They're depleting the portfolio as a result of inflation and distributions and taxes and so forth. And they end up, both of them pass away at 95. And the portfolio is worth $762,000 at the end of that period. So they've seen some increase, some decline, and they have $762,000 left over. So we run a Monte Carlo simulation to illustrate what exactly that means. So what Monte Carlo does is it takes all of this volatility and it randomizes the performance to compensate for it. So in other words, the Monte Carlo simulation says, yes, some years the market's going to be up 20%, but there are some years that the market will be down 20%. And what does that mean for the portfolio? It runs 1,000 different illustrations, including that type of volatility. So some years they're down, some years it's up. It runs all those 1,000 illustrations, 1,000 analysis, and then it averages that analysis to see where the portfolio ends up. So if you look at the end result here, you see 3 lines. And if we saw below average performance of that 1,000, maybe the bottom 20%, they would end up with about $577,000 left in the portfolio. The average is about 945, but if they saw outsized performance, so they were at the top 20%, then maybe they would have $1.6 million left in the portfolio. But you see there's a dispersion over that time frame. The longer the time frame, the more volatile the portfolio, the greater the dispersion. But in this particular portfolio, with the volatility that we see right now in this allocation, including this 20% decline, you include that in the analysis through Monte Carlo simulation, and then you say, what's the likelihood that we will be successful? This particular portfolio at the beginning of 2022 had a 97% probability of being successful. So when we run your analysis and we're doing the same kind of illustration, we do that summary and we say, is this a reasonable probability? So we cut that off at around 85%. So as long as it's above 85, we feel like that's a pretty strong probability of success. And in this particular case, it ran to 97% based on that growth rate and that distribution rate. 97% is a pretty healthy relationship. So let's go back now, and I'm going to make a bit of a change. What we're going to do is we're going to rerun this analysis based on today. And now the portfolio is down 20%. So when folks come to us and they say, oh, you know, we ran the analysis at the beginning of the year, and I know that I had a 97% probability of success at the beginning of the year, but now the portfolio is down 20%. What does that mean for my portfolio success in the future? Well, what you have to remember is that the 97% included years of volatility where the market has declined like it's declined today. Doesn't happen really often, but it happens often enough that we want to include that in the analysis. And we do that through the Monte Carlo simulation. So the first thing that I'll note is that we have bumped, in this illustration, we've bumped that return just slightly because now with the valuations improved, we have a higher return outlook for the next few years. And so instead of a 4.99% return on this portfolio, we have assumed that that return has now gone to 6.1. So our assumption is 6.1, but believe it or not, I've only used 5.8 in this particular analysis, just to be a little more conservative. So maybe we've overestimated slightly, but we assume a 5.8% analysis return in this particular analysis, and I'm going to show you how it plays out. So the first thing is when you see here, this starting point is $200,000 less than it was in January of 2022. Not surprising, because that's about where everyone is. It's roughly 20 to 22%, 23% maybe in some of the more aggressive portfolios that the market is down. The portfolios are down for the year. So we're seeing some pretty hefty volatility that we haven't seen in the last 14 years or so. So this is a little hefty volatility, but not unexpected. And so what we've done here is we've said this portfolio is now down 200,000. So our starting point is 800,000. But look what happens here when we bump that growth rate. We bump the growth rate just by about 0.8%, not even a full percentage point. And the portfolio grows as it did before, but it grows a little bit longer before it starts declining. And then it declines. And believe it or not, the difference at the end is only $12,000. Now, I did not manufacture this number. We just took the valuation metrics that we see. We consulted our research partners, and it's all the companies that we use their economists, and BlackRock and JP Morgan and Vanguard and Fidelity and Dimensional and all these companies that provide us economic research. We aggregated that research to revise our outlook performance numbers. And unbelievably, when I incorporate those numbers in this particular analysis, the client ends up with exactly the same result. In fact, when I look here and look at the Monte Carlo summary, the result is 97% probability. So you can ask me the question, Scott, are you telling me that even after a 20% decline in our portfolio value, that our retirement plans are still intact? And the answer to that question is a resounding yes. So if your portfolio distribution rates worked in January of 2022, they will continue to work today because of that relationship in valuations and performance. It's a very simple concept. When things are cheaper, the outlook is better. So I want to show this illustration to you. Here's the bottom line as we look at these two performance numbers. We go forward here and you can see the summary. So volatility is not uncommon or permanent, and therefore we account for it. And by accounting for it, the retirement plan is not at risk. And so you can see this is the before version of that illustration, $1 million portfolio with a slightly lower growth rate because the valuations were too high, versus an $800,000 portfolio with a slightly higher growth rate because the valuations now are much lower. And as a result, the outlook for performance is higher. And what happens? We end up with nearly exactly the same portfolio amount, and the probability of success is nearly as high. In fact, in the previous illustration, it was exactly the same. So the question then bears, one more, I guess, and that is, does that mean that I just keep going on as I've always gone on? And I will say, I've mentioned it before and I'll reinforce it again. No, the answer to that question is absolutely not. During periods of volatility, there are things that you have to do to compensate for that brief period of volatility. And this is the list we've mentioned before, the things that you do to take advantage of volatility like this. The first thing is you want Roth conversions. Whenever the market's down like this, it will eventually come back. Do you want it to come back in a taxable environment, or do you want it to come back in a tax-free environment? Of course, you'd prefer it to come back in a tax-free environment. As long as it works with your tax picture, that's something that everyone should do. The next thing is you should be doing tax loss harvesting, because during these periods of volatility, you expect really fast recovery. There will be taxable gains in the recovery. You can use these losses to offset those tax gains that happens later on. We focus on rebalancing. We're watching for those valuation dips so that we can buy those valuations when they're down, giving us much more upside potential in the portfolio because we're buying them when they're cheaper. Now, number 4 is where you really come in. Number 4, during periods of volatility, there is something that they call sequence of return risk. And I won't go into the details about that, but what it basically means is when there is market volatility like this, if you continue to spend the same way, you put your portfolio at greater risk because you're pulling the same dollar amounts from the portfolio during periods when the portfolio has declined. And so it basically costs you the difference in the portfolio value. So what we emphasize is control your spending. Monitor the spending in a way that you're not spending the big expenses during years of volatility. So postpone a car purchase if it's a big percentage of your portfolio. Postpone that around the world trip this year to maybe next year when the portfolio has an opportunity to recover. So avoid large purchases. And most importantly, if you have monthly distributions, it's a great time to stop the distributions and pull from your emergency fund, use your home equity line, avoid distributions on the portfolio until it can recover. And basically you control then the sequence of return risk. You then put yourself back in the driver's seat, and that's how you protect your portfolio during times of volatility. And then most importantly, remember, times of volatility like this are absolutely normal. It is not something that we're surprised by because they come around frequently enough that we shouldn't be surprised by it. It's absolutely a normal part of the market cycles. We go through these cycles, we come out on the other side. It has always been that way. It's likely to always be that way. So be patient. Be patient and expect for the market to be volatile during periods like this, but that the volatility is typically short term. I mentioned before that 20% declines on average last about 14 months. That would put us at February of 2023. You have to be patient to get to that February of 2023 time frame, and maybe it'll go beyond that. Maybe it'll be a bit shorter than that, but it is not forever. And if you know that and you can hang on to the portfolio and rebalance as you should and control the spending, you'll be successful, and just don't make mistakes along the way. So it's critically important for you to understand. I want to thank you so much for placing your trust in us, but also I want you to know that we've taken into account this type of volatility every time we run a financial plan analysis. And if we've said to you, your plan is secure, that means that we have considered the 10% declines, the 15% declines, the 20% declines, even the 25% declines that we've seen recently. They don't happen often, but they happen often enough that we have to include it in your analysis, and we've done just that. So you can rest comfortable that things are in good shape. You can go forward thinking that, this part of our portfolio is secure. We can, as long as we control the spending and just postpone the big expenses until the market has a chance to recover, everything will be fine. If you feel like you want us to run the analysis for you again, we're happy to do that. In the meantime, I hope you have a great rest of your weekend. Let us know if you need anything, and I'll look forward to talking with you again soon. Thank you very much for your business. Thank you for the opportunity to spend some time with you today, and I look forward to talking with you soon.